All right, welcome everyone. We are here for bridging the ESG coverage gap with NLP. We have a great panel here to talk about this. We have Douglas Hopkins, Mariana Souza, Sam Levitt. They're excited here to talk to everyone about it. Before we get started, just a couple of things. For anyone wanting to answer questions, we will be doing questions, but at the end. But definitely feel free to use the question feature in the webinar tool, or you can just use the chat, and we'll take a look at those, and then we'll be able to answer them at the end, like I mentioned. So with that, Doug, take it away.
Great, thank you, Juan. Good morning. Welcome everyone to our ESG webinar, Bridging the ESG Coverage Gap with NLP. As we all know, ESG considerations have become increasingly important for investors, regulators, and investors alike. As Juan said, joining today are Mariana Souza, Director of ESG Climate Advisory at KPMG, and Sam Levitt, who is the ESG lead at Amenity. They're going to share their insights today on how FinTech can help drive positive outcomes. We hope you find the discussion informative and thought-provoking. Before we dive into the agenda, we thought we'd start with a brief overview of both Amenity and ESG's and Amenity's ESG offering. Amenity is a 7-year-old AI firm specializing in contextual NLP and granular taxonomy. Amenity was acquired last November by Symphony Communications, and we are thrilled to be part of the Symphony team. So at the core, Amenity turns unstructured data into meaningful insights that have a material impact on our clients' workflows. We use contextual NLP to identify relevant topics and themes, and we build bespoke taxonomy on the backside of that. We do both solutions for our clients, and we have a number of products as well. In ESG, we cover both transcripts and we cover ESG global news in real time as well. In ESG, contextual NLP is critical to capturing the broad themes and topics under a very, very wide ESG umbrella. Our current NLP taxonomy has approximately 800 threads that are rolled up to subtopics and finally into the ESG groups. You know, Amenity's clients use both our sentiment NLP as part of the output and counts. And within our data sets, we capture both the firm's narrative in transcripts and Q&A and interim reports, as well as the media's narrative in real time in ESG. So there's some really interesting intersects between the two data sets. That's a brief overview of Amenity. Mariana, would you mind giving an overview of the KPMG ESG offering?
Thanks, Doug. Would be happy to. Great to be with all of you today, and thanks to Amenity for hosting. Mariana Souza, I'm a director based in New York in KPMG US's ESG and Climate Advisory practice. As a US member firm, we're part of a network of KPMG companies across the globe. We have a global network of ESG, sustainability, and climate professionals. Lots of growth in the past 2 years. My team specifically focuses on ESG and climate strategy, so we sort of do the upfront assessment and design work. What should companies and financial institutions be thinking about when they're building an ESG program? And primarily serve financial services clients, as I mentioned, portfolio companies, private equity, and then the corporate space as well. I'm a champion of the Amenity platform within my organization, so I'm excited to be here today and happy to share. Looking forward to sharing some case studies for the next hour. So I won't drain the slide. I think those that are on the call right now don't need to be convinced why ESG is important. I'll just highlight the two sort of the pie charts in the center. KPMG does an annual survey of CEO perceptions, and most recently this 79% I thought was quite striking, that 79% of CEOs believe the public is looking for businesses to fill void on societal challenges. So there's a really high and increasing expectations that businesses are both transparent in their actions and providing impact. So this is not, you know, government will save us. CEOs are really embodying the sense that they have what is the organizational purpose, and how can they go beyond minimizing harm in the world, but actually making a positive impact. The other side of that is that there's a lot of pressure on stakeholder reporting. So I think it brings us nicely into this discussion.
That's great. Thank you, Mariana. And rolling into the discussion points. So how has the field of ESG changed in the past year, and where is it heading moving forward in terms of new laws and regulations? Sam, I'll let you take this one first.
Yeah, thanks, Doug. My name is Sam Levitt. I'm the ESG product lead here at Amenity. I think the one thing that's been top of mind in terms of ESG is all the new regulations coming down the pipeline. In the US, we could be living in a world where by 2024, companies could be required to disclose scope 1 and 2, as well as other material considerations. In Europe, CSRD has been passed, and that's going to require material ESG disclosures on a wide range of ESG topics. I think from an asset manager standpoint, we're seeing a bit more stringent regulation around greenwashing and fund management in particular. And then on the laws and subsidies side, there's a lot of new funding rounds, particularly the Inflation Reduction Act in the US, as well as other types of subsidies and green deals in the EU. So it's really two sides. There's regulations, but there's also new money being poured into a lot of sustainable development. And speaking of new money, there's also healthy inflows into a lot of these ESG funds from investors. So Mariana, it would be great to get your thoughts on how the field of ESG has changed in the past year or so.
Yeah, the context that we usually bring to our clients is, a couple of hockey stick graphs. The sheer volume of money going into products, whether that's funds of funds, portfolio company-based investments, CLOs, right? At any flavor of financial product, if it has ESG tied to it, it's getting more attention. If it has transition finance or sustainable development tied to it, it's getting more financing. And so when we think about the growth of ESG regulations and, will they, won't they, SEC releasing in April, I think the context we set is that there's evidence in the market that there is a premium for ESG integration or thematic investing. And that means that investors are looking for comparable data that's being assured, or looking to normalize, if a product or a corporate is claiming to have some ESG or impact benefit, how do you actually demonstrate that and prove it out to avoid greenwashing? It can feel a little bit oversimplified, right, to say this is all anti-greenwashing, but I think it is a really big part of it. And then, of course, when we think about the climate crisis and companies are planning, what's my capital, what are my infrastructure investments that I'm making over a 20-year horizon? Are those the right things to do in light of potential climate regulations and actual physical impact of climate change? So whether or not the rules get finalized in the next few months or it takes a year, I think the message is that investor demand is here, and we don't expect that it's going away anytime soon.
Great, appreciate it. And we're going to do questions at the end. If anybody has any questions, they can type it in the question or the chat bar, and we'll cover those at the end. Thanks, Mariana and Sam. What issues and topics are gaining prominence in the ESG investor space that have not received much attention or investment that we should be aware of? Sam, I'll let you take this one again.
Yeah, thanks, Doug. As we mentioned earlier, for Amenity, we cover news and earnings calls, but a good place to look for investor attention is earning call topics over time. So what we saw, particularly in Q4, is an uptick in offshore wind, recycling, as well as some increases in circular economies. So later on, we'll get to what kinds of industries are being talked about in these kinds of topics, but a lot of it has to do with new permitting, especially in the U.S., new wind projects in Virginia and off the coast of New York and the Atlantic area in particular. So that's one avenue that we've seen some increased attention for, as well as other topics like carbon capture, green hydrogen, things that are really more derivatives of the renewable space, but are starting to evolve as the renewables space is becoming more mature. So there's tons of topics in ESG. New ones are popping up every day. Mariana, it would be great to hear what you and KPMG are seeing in this trend-setting kind of theme.
Yeah, I mean, climate, decarbonization, net zero, definitely the topic du jour right now. And I think sort of a sub to that is biodiversity when we think about the Task Force for Nature-Based Disclosures. I'll say the language and like the analytics used in the market around nature-based and biodiversity reliance is a bit less mature, but I think it's going to get a lot more noisy next year. I think two other really big topics for us are labor issues and then supply chain risk. So from a labor perspective, a lot of the discussions we've been having recently, particularly in the US market, is, historically there's a belief that we were not exposed to as much labor risk. There's definitely an increase in unionization. If we think about the context of Great Resignation last year, obviously we're in sort of recession, not recession at the moment, but increases in sort of what the position that labor is taking. And I think there's also, on the negative side, we've had a couple of cases recently of these news stories of child labor in the US, right? These were issues that we didn't think was something that companies needed to manage from an ESG strategic risk management perspective. So really interesting dynamics on the labor side. And then of course, sort of managing risk in supply chain. I think as language gets more refined on scope 3 purchase goods and services, that's definitely having an impact on how companies look down into their supply chain. But also what's the risk in your supply chain and how would that get impacted by ESG regulations, whether it be carbon pricing or something else, right? I worked with a company recently that makes products with plastics, and we looked at what the virgin resin prices would be in different climate scenarios over the next 30 years. And that type of change, whether you believe there's going to be carbon pricing in the US or not, the potential complete shift of like the economics of your business model, I think the more data we have available, that it's starting to impact sort of business strategy and how you diversify your product. And related to all that, right, is like understanding where your big customers are also trying to go. So the large consumer facing brands in the US, while they continue to sort of lead on ESG and put pressure down into the B2B and mid-market. Lots of new content is the theme of the year. Everybody's learning a lot about everything.
That makes sense. It's difficult to keep up, so it's good to hear.
Yeah.
Speaking of, thirst for data, where do traditional ESG data sets fall short? And how does NLP, natural language processing, help fill those gaps? Mariana, I'll let you take that one.
Yeah. So as I mentioned, I'm a big champion of using Amenity product in our work. So if I think 2 years ago, one of the foundational ways, well, it continues to be foundational to how you do ESG strategy, is running these materiality assessments. So for a given company, or if we're working with a financial institution, if we're looking at sort of an industry set, what is the long list of ESG topics and which of those are going to be most material to you? So if you are in industrials versus fintech, right, you're going to be solving for very different things. You're sort of like supply chain risk if you're industrial is going to be bigger, very expensive capital. What's the total cost of ownership versus fintech is like, all right, what's happening in the cloud and what's my cybersecurity protocol will be more material. So when we think about doing those materiality assessments, previously we relied pretty heavily on what was in a public ESG report. And it's great and it's very helpful. But when I think about pulling a set of ESG reports for across 10 peers, you know, there's content there versus when I can use Amenity now, I get the public ESG report, but I also get 10,000 news articles that are categorized by sentiment, by theme for an industry, and seeing how that changes over time for us has been tremendously useful to sort of share to make it a bit more real, I think, for our clients, because ESG reports have gotten longer for many years and they are complicated and they serve sort of dual purposes of investor clean data, but also marketing. And when you can combine that with, in your industry, there's a ton of negative sentiment around pollution management because you did not properly manage your sort of effluents in, you know, a certain river valley, like that makes it really real and tangible for a client to think about what risks and opportunities do I need to be managing. So yeah, I think it's just, the volume of data has been tremendously helpful for us to help get the insights faster. Sam, you know, this is your baby. Tell us some more.
Yeah, thanks, Mariana. You know, what we've found with news is that it typically increases the volume of our data and ESG insights by tenfold compared to what we would just get from earnings calls and filings. So this is a chart of our news mentions filtered specifically for our materiality model. So we look at commitments, investments, exposures, and milestones. Particular language around, you know, where companies are either making a commitment around ESG or taking a specific action. So getting a little bit beyond just general mentions of ESG and focused more on the behavioral, strategic side of what companies are doing. So we put this news chart in terms of the Inflation Reduction Act and looking at capital inflows into the U.S. In North America as part of that resulting action in the Inflation Reduction Act. And what we see here, there's a lot of companies, European and from other areas, that are investing in the US in terms of EV batteries and production. So we see Hyundai, BMW, but we also see other parts of the supply chain, Rio Tinto investing in aluminum recycling, Bridgestone investing in sustainable rubber. So what we've been seeing is not just the EV space, but infrastructure, materials, energy and utilities are all becoming part of this evolving economy in the green space. And that's, you know, something that we look for in the news, so we can see not only when companies are making these announcements, but you know, running our models on a daily basis and looking for, you know, when are they breaking ground on these facilities? You know, what are the other, you know, supporting plans that they have to launch these new businesses? And with traditional ESG data sets that come out quarterly or annually, you're unable to do this type of analysis in real time.
And like this view, Sam, just to go a bit deeper on like how we would use it, right? Because the market is moving so quickly, and we know that like it takes a lot of effort to get a nice glossy report out or tidy up the press release that summarizes, like being able to share this view with our clients who say, I want my portfolio companies, or I as a company don't want to be lagging. Like, it's, even if you want to stay at pace with your peers, you need to move pretty quickly. So this type of view for us has been, you know, it just, I've said it already, but like it makes it really real for our clients to understand, like, that whatever you are planning for, like the pace that you have, your transformation program probably needs some additional bodies and attention.
Yeah, that's a great point. And this was a big part of our 2022 roadmap. Our particular European customers, excuse me, said they were having difficulty capturing the notional amount of firms' commitments, and then they wanted to see if there was a knock-on announcement of an investment. So the notional amount of commitments and investments, and we took it a step further, you know, what's the materiality theme is part of the data set. And then a further step forward, if they're mentioning what the metric tons they're looking to save in carbon capture. We also put that in the data set. So in addition to themes and topics that we do as part of that 800 thread taxonomy, adding the notional commitments and investment and underlying materiality was added to our data set in the middle of 2022, and it's been very popular.
Yeah. Everyone's racing to being like the $2 billion investment on transition finance, but is that advisory fees? Is this actual commitments and financing? So yeah, it's been very interesting to say the creativity in the announcement.
And this next question fits right into that. What are the pressures? What are the pressures for firms? What are the pressures for executives facing shareholders, employees, customers in the community? What pressures are they under, and how's that driving ESG? Mariana, I'll let you take that one as well.
Yeah, it's I don't envy some of the executives that we're working with right now, because there is sort of this dual challenge of transparency and rigor. But when we try to sort of simplify it to make it feel a little bit more manageable with our clients, right, we group it into these three categories. So one is the factual, physical risks being the biggest, and then there's the sub items there of like biodiversity reliance, asset exposure. What's the societal pressure? So consumer and employee sentiment is shifting pretty significantly in terms of, and it's not just about sort of like an increased willingness to pay. I think the expectation is, I often use Method Soap as the example. They are very oriented towards sustainable products and packaging, and they have a really interesting sort of employee ownership, like supported worker model. But they were sold in Target, and they didn't focus on sustainability. They just had a really good product and nice branding, right? Like, I think that's what we're expecting as we go forward, that companies that are really focused on innovating around sustainability challenges to have a great product that is of a comparable price point, like through true innovation, different chemistry, thinking about a supply chain model differently, are the ones that are going to be the most successful. So I think it's just the bar has really been raised sort of from a societal perspective. And then it's the same with investors and capital markets. And then, of course, the regulatory space is normalizing and putting it down on paper and structure, like, what do you actually need to demonstrate in your criteria if you're trying to get an ESG green premium? But that also means that there's a lot of sort of confusion and stress. And what we are doing a lot, as historically, like KPMG is audit, tax, and advisory. We were known for being accountants. I am not one, but that's sort of the public accounting firms are now having a lot of conversations with our chief controller clients, with our chief accounting officers, with general counsel, to say, the way that you think about your financial reporting, some of that ESG data, right, in the US, it'll probably be climate, human capital, and cybersecurity. Think about, like, what's the SOXification of that data? What are the processes and controls around that? If a topic is truly material to your business, you should be forecasting the performance, and it should be going to the board, and there should be management level dashboards, right? So that transparency again, but also the rigor to say, if we believe this information is material to us as a business, let's get it right and make sure that it's high quality. And then from the investor perspective, right, there's going to be an explosion of assured ESG data. And after a few years of that, there's going to be a lot more clear linkages to, risks and opportunities A, B, and C are actually material to this industry in a way that we didn't expect, or going to be more material and for the industrials versus a fintech company. So yeah, those are some of the pressures that we're seeing right now. Sam, anything else to?
Yeah, I think in that vein, what we're seeing is investors are, we're done hearing about 2050. Investors really want to hear about the plans for 2025, 2030. Not just net zero by 2050, but what are all the steps in between and how to get there. I think a good example of this is, Doug, what we see during Climate Week, where we see a big spike in commitments, and then the rest of the year, the resulting action and investments around those Climate Week commitments really lags. So I think investors, shareholders want to see, how sustainability is going to drive value for companies going forward, and not just be something that's talked about once a year during Climate Week. But how is this really embedded in the program and going to be part of strategic behavior going forward?
Well, that's a good point, Sam. We actually released a data feed, a greenwashing data feed that captures just that. Our firm's making commitments, but we're not seeing subsequent investments. And it's been it's an additional feed to our ESG transcripts and news data feed, and it's been very popular. Sam, another thing, a couple final question, but I have some questions beyond that. Going into the rest of 2023, what ESG themes do you think will drive corporate discussion and behavior, Sam?
Yeah, thanks, Doug. I think this is a good time to go into what we've seen in earnings calls in this past quarter, and some of the themes that are evolving. One is that wind power has seen a big uptick in the past quarter or so, and that's really being driven by utilities and industrials, which might be kind of surprising. When we think about the way the world runs and the infrastructure, for really the past 100 years or so, that's been geared towards fossil fuels. So we're seeing a major groundswell where a lot of these companies that were involved with offshore oil rigs, capital goods for those types of industries, are really seeing demand for offshore wind in particular. So a lot of these companies are not only participating in this economy for offshore wind, but it's generating a really healthy backlog for them. Some more specifics around that. A company that does offshore platforming in their earnings calls, they talk about how for an oil project, it might be only 2 or 3 platforms, but for offshore wind, it'll be 100, 200 platforms. So that's more materials, more capital goods, more man hours, to make these platforms. And it's really generating, being a large revenue driver for these companies, as the world changes before our eyes from a fossil fuels world and economy to an offshore wind, solar power, renewable world that we're heading towards. And the utilities and industrials in particular are seeing more of that in recent quarters. Another example of that is recycling. I think when we think about recycling and circular economy, we think the consumer discretionary sector, consumer staples. But what we've actually seen is a decrease in the consumer discussion and earnings calls for recycling, and a large uptick in industrials and materials again. Getting back to what we saw in that graph on news, where a lot of these companies are investing in metals, recycling, batteries for lithium, that kind of thing. That's going to drive value for companies by reducing supply chain costs. If you can recycle things and reuse things near where you're manufacturing, instead of having to mine and import metals from halfway around the world, that's not just environmental consideration, but it's also a business and efficiency consideration. So that's getting back to investors want to see not just how companies are talking about ESG, but where is it really driving value and efficiency for the company and the bottom line as well.
I think related to all of that, Sam, is where we're seeing interest and demand on helping companies get support with accessing IRA funding, CHIPS funding as well, right? So the complexity for a company that's not yet submitted an application to the Department of Energy, when we think outside of sort of the utilities space, right? If you are you've got a ton of plants across the US and you want to put in new like waste processing, or you want to put in, you know, your own clean power solutions to get off the grid. There's tons of money available, but it's actually quite challenging to go get that and then be ready to provide the ongoing performance reporting that's expected to go get these grants. So it's not something that I specialize in, but we're working on a couple of, in my team, a couple of really large grant applications for IRA. So it'll be really interesting to see how investors sort of like make a programmatic approach to, you know, do the way they think about portfolio construction, like how much is that changing based on the level of effort required to go get that funding. It could totally change your capital stack, but like, you know, what's the overhead to manage those requests to go get that money, and how certain is it? So it's a super interesting time.
Well, that's great. That is the agenda for today's call. We do have a couple questions that have come through on the feed, and I think they're good questions. The first question that we have is, and if you have any additional questions, please put them in the feed. Thank you, Sam and Mariana. Where are your ESG roadmaps headed in 2023? What's next, both for KPMG and for Amenity? And Mariana, I'll let you go first on this one.
Yeah, at the moment, for KPMG US, there's a lot of planning for CSRD reporting requirements. So in the EU under EFRAG, there's the Corporate Sustainability Reporting Directive, and then its partner SFDR for financial products. And the way that the EU requirements have been set up is that it's not about being a public company. If you have operations and a certain amount of revenue and headcount in the EU, you're exposed to those reporting requirements. So in practice for my team, and the sort of bread and butter that I do all the time is shifting from these sort of voluntary materiality assessments where we do a lot of desk research, we do executive interviews, we get sentiment analysis from a ton of different, from like up and down the value chain for a company, to how do you demonstrate that you've run a double materiality assessment for financial reporting, essentially. And that double materiality is both financial materiality, so is energy usage material to you as a company, and then also impact materiality. So what are the ways that you are actually impacting the communities in which you operate, or the communities where your raw materials come from? And so it's a really interesting construct because it's both additional, greater research that's required, but also needing to document for an auditor, show me how you identified that topics were material, yes or no. And then if they are, they'll have to go in financial reporting. So, you know, then your internal audit team is involved, your controllers are involved. Like it's a whole new world. So we're sort of blending, what was, you know, a voluntary strategic set of activities with, okay, now we need to do a bit more documentation. So there's a lot of partnering across service lines within KPMG, to have people who are super strong on the accounting side, and then folks like me who know about more of the like translation of what the investor expectation is. So that's really big. Of course, SEC climate rule readiness is big. And then just net zero readiness broadly. I think a lot of companies, particularly financial institutions, are trying to understand, you know, what is it? It's nice and good to say that we're aligned to net zero by 2050, but when it gets down to brass tacks, like, what am I going to do differently? How does my diligence change? Am I now going to be thinking about exclusions? How do you think about investing in energy in different developing economies, and what's the sort of social justice aspect of keeping funds from certain regions? So there's a lot going on in net zero readiness, and I think it's bringing up sort of strategic positioning questions that, you know, have been really fun to work on. So those are the three big categories for us. What about you, Sam?
Yeah, I think, you know, there's definitely a lot to consider from an ESG standpoint. So our job at Amenity is, you know, taking all these considerations and, you know, figuring out what is going to be most valuable for our clients to understand the ESG market and landscape as it evolves. I think, you know, top of mind for a lot of our clients and data users is CSR reports, being able to run our models on these sustainability documents that'll give us a greater understanding of the company's ESG narrative, what they're planning from a metrics-based standpoint, but then also being able to track these commitments from the CSR reports and follow that up with news and see, you know, how are they doing on their water goals? How are they doing on the carbon goals or diversity goals that they set out in their CSR report? And then being able to follow that through news for the rest of the year is something I think we find very compelling. Also, private company coverage on ESG is another avenue that we've been exploring and hearing about from our clients. You know, with private companies, a lot of them don't have the filings or earnings call documents you get with public companies. So news data that we really specialize in is the only way to get visibility into some of these companies' ESG narratives. And then I think, you know, being able to summarize the news with some of these large LLMs that we've been seeing, aggregating all of our insights from news and being able to generate concise summaries. You know, whether you're going to be writing a report on a company, you need to get some slides ready at the last minute. Being able to aggregate our news insights even quicker at scale is something that we find really compelling and useful as well going forward.
Great. We have another question. Do you think ESG disclosures will become mandated by the SEC for filings?
Happy to take that one from my perspective. So there was a sample letter that was published sent out by the SEC, I think last year, that it was focused on climate. It was mostly going to energy companies, and the content of the letter from the SEC is, hey company, we noticed that you have more expansive disclosures on climate risks in your CSR report than you had in your financial filings. Was it reviewed by your auditor? So I think, like, on the one hand, the reporting is already mandatory. If you're a company that has highlighted an ESG related risk in your financial report and you also talk about it in your CSR, the SEC is looking at, you know, is there a lack of compliance? Because the rule for the SEC is, if the information is, materiality is defined by would a reasonable investor want to know that information, would it impact their decision making, right? So to a degree, I think that the ruling is here. I also expect that there's going to be lots of litigation and debates. I've also heard from a couple of our sustainability, like chief sustainability officers at large clients, have referred to this year as sort of end of an era, where they were the responsible, accountable party for publishing these ESG reports. They certainly got, you know, a letter from the CEO, but every metric and data point and case study in that report wasn't getting reviewed, wasn't getting, you know, validated for, is this accurate, factual? Does the criteria make sense? Is it logical? Did someone check the data above you, right? So there will be some noise, I'm sure, from a regulatory perspective, but you know, but I think the laws are kind of already, a lot of them are already in motion and in place. So I will be quite surprised if, you know, the anti-woke hoopla wins out here.
Appreciate that.
Yeah,
and Sam, we'll do one final question. I think this one is probably for you, Sam. It's asking if in our data, in our news, ESG news data, do we cover both public and private companies in our ESG news data? You can take that, Sam.
Yeah, so we definitely have a much larger coverage in public companies, but we do private company coverage. That's still a growing area for us, but you know, our news models run on private companies. That's something that we've been working on to have in production, and we're also working to, you know, expand the companies that we cover. So yes, we do cover private company news and ESG, and we're building out that use case more as we work with our clients on it, and as we, you know, see more companies in the private space being talked about in terms of ESG.
That makes sense. Well, that brings us to an end of the webinar. We want to thank Sam and Mariana for joining us today, and we want to thank all the participants for joining. Juan will be sending a copy of this webinar to you as well, and the emails are here if you want to contact Mariana or you want to contact Sam. Please feel free to reach out with any other questions you have. And thanks again for joining today. We appreciate it.
Thanks for hosting me. Bye, guys.